Hi all, welcome to this tutorial. In this tutorial, we are going to discuss about working capital management. As we know, the working capital is the fund or is a capital that is available in the business to manage the day-to-day activities. So in the business, there will be some investment, some long-term investment, like in the fixed asset. There are some short-term investment also in the current assets. So the working capital will come under the short-term investment. So that is the fund available to manage business day-to-day activities like the sales, purchase, expenses and other activities. So to manage these types of activities, businesses are normally maintaining a fund that we call as working capital. Is the focus to ensuring that company have sufficient liquidity to meet its short-term obligation while maintaining operational efficiency. There should be a balanced approach for the working capital management. So it is the process of ensuring that company have maintaining its short-term liquidity position while maintaining operational efficiency also. The company cannot wildly invest in the working capital because it will affect the overall operational efficiency and the investment return. So the proper working capital management is a balanced approach which focuses on to maintaining the proper liquidity while keeping the return on investment also higher. So there are two approaches are there or two things are there to consider. The first thing is to maintain the proper liquidity to perform the business. And the second thing to ensure that the business are getting the proper return for its investment. The working capital decision directly affects the first thing it is liquidity. So if you are increasing the working capital, definitely our liquidity is getting affected or getting increased. There's a profitability. If you are investing more into the working capital, definitely your return on investment will be getting down. So and related to risk also. So the three things which will directly affect first thing is liquidity, then the profitability and the risk. Then the poor management can result technical insolvency even when company is profitable on paper. The poor working capital can result the technical insolvency also because in the sometimes if business doesn't have enough fund in its working capital, it cannot meet the short-term obligations, so it will create the short-term insolvency and liquidity issues. So in the working capital, it is very important to maintain the proper liquidity while maintaining the profitability also. Both things are very important in the working capital management. So let's move more into working capital. The first thing is definitions of working capital. The formula for working capital, it is net working capital is equal to current asset minus current liability. So what is our total current asset minus what is our total current liabilities? That is net working capital. So where the current asset include first in cash and cash equivalent, then the marketable securities, accounts receivable, inventory, and the prepaid expenses. These are some example for current assets. So from this total current asset, if you reduce your total current liabilities, that is your net working capital. The current liability may include accounts payable, short-term loans, accrued expenses, and current portion of local debt. These all come under the current liabilities. So if you reduce your total current liability from the total current asset, that is your net working capital. Working capital measures short-term solvency and ability to meet obligation as that become due. So if you have enough working capital or enough liquidity, what it means that the company should able to meet the short-term liquidity and able to meet the short-term obligation when they become due. Now let's move into objectives of working capital management. The primary objectives of working capital management is to minimize the cost of maintaining liquidity while avoiding insolvency risk. The key objectives of working capital management is to minimize the cost of maintaining liquidity. Company has to maintain the liquidity in the business at all time with the minimum cost while avoiding insolvency risk. So here this is created classic risk return trade-off. Holding more current asset means you are lowering insolvency risk but lower the total return. If you are more invested into working capital or into current asset, definitely you are lower insolvency risk are there. But it can create a lower return situation as well, because more money are invested into working capital and it is not producing or it is not giving any benefit to the company, so which can create a lower return. Again, the opposite situation, holding fewer current asset, the return will be higher but greater liquidity risk. So if we increase the only holding the fewer current asset or fewer mainly only the little working capital, so it can result higher overall return because your investment is very low in the working capital, but it can create a greater liquidity risk because you are making only few current asset, so there will be chance of liquidity risk in the future. So the management must wisely choose the better or the optimal working capital level which will maintain both the liquidity and the profitability or the liquidity and the return. So these both things has to be maintained. Once the business should be always liquid and maintaining the liquidity in the business and also maintaining a proper or a target rate of returns. So to conserve these two things, the business has to decide or the management has to decide the optimal capital structure to the business and should maintain that optimal capital structure at all the times. Then let's move into operating cycle and cash cycle. Operating cycle. Operating cycle, it is simply mean it is a time between purchasing inventory and collecting cash from the customers. Suppose if I purchase some material today, so today is my day 1 and I'm selling this material on 15th day. So it is 15th day to sell my material and I'm taking another 20 days to collect that receivables from the customer. So this 50 plus 20, 35 is my operating cycle. Operating cycle simply means it is a time gap between the purchasing inventory and the collecting the cash or collecting that receivable from the customers. So it includes the time gap between the purchase of material, then if it is a production process, then the production process gap is there, sale of goods and the collection of receivable. So it is the time to take from the purchase of material to collection of receivable, which include the production process, sales of goods and any other process can be considered in this operating cycle. So finally the operating cycle, it is the time to take to purchase of raw material to the collection of receivables by using that raw material. Then the cash cycle. Cash cycle is similar to operating cycle, but it is the time between paying inventory and collecting from the customers. In the cash conversion cycle or cash cycle, we are not starting the day from the purchase. We are starting from when we are paying to that supplier only. Suppose I am paying to my supplier today. So today is day 1 and I am getting my receivables on after 15 or after 15th day, then my operating cycle is 15 days. So to calculate the cash cycle from the operating cycle, so you have to reduce the payable period from the operating cycle to calculate the cash cycle. So the difference between two cycles represent the period supplier financed the company. So what is the difference between the operating cycle and the cash cycle? In the operating cycle, we are considering the from purchase of raw material to the receipt of cash. But in the cash cycle, from the payment of supplier to the cash collection. So the difference between the operating cycle and cash cycle mean how many days or how many period the supplier financed the working capital requirement of the company. That will be the difference between the operating cycle and the cash cycle. Let's look into an example. Suppose if a company maintains 60 days inventory in stock. So that means, and the receivable 30 days. That means if a company purchases the material, it will sell only after the 60 days. And after the sales, it will collect the receivable. It will collect receivable only after the 30 days. So the total operating cycle in this case, it is 60 plus 30, that is 90 days. But we have a payable period of 40 days, which means in the cash cycle, from the operating cycle, you can reduce that 40 days. So in this example, the operating cycle is 90 days, but the cash cycle is 50 days. So in the cash cycle, we are reducing payable period from the operating cycle. So in this example, what we can say that the total 90 days is our operating cycle. So out of this 90 days, 50 days the company have to finance the working capital, and 40 days the supplier will finance our working capital requirement. So let's move into types of working capital. Types of working capital is, the first category is permanent working capital. Permanent working capital is the working capital which is a minimum level of current asset required to supporting ongoing operation. So this working capital has to be maintained at the all time. So that's what we call as permanent working capital. So it is a minimum level of current asset or minimum level of current working capital to be maintained in the business at all the time. Then let's move into temporary or seasonal working capital. Suppose there is you are operating a seasonal business, there will be some seasonal fluctuation or demand fluctuations are there. So due to that peak season, you have to maintain some more inventory and you will have some more receivables than the normal period. So this working capital is what we call as temporary or seasonal working capital. Suppose a seasonal retailer built inventory before peak sales season. So he has to maintain that inventory before the peak season, and definitely on that time the receivable also will increase temporary. So these two things, in this example the temporary inventory and temporary build of receivable, these two are the temporary working capital requirement. So the temporary working capital requirement is a seasonal working capital requirement to manage the seasonal business demand. Then working capital policies. There are two types of working capital policies. Then the first one is conservative, then the aggressive working capital policies, or what we can as working capital approaches also. Conservative meaning conservative working capital policies, the company is invested wisely in the working capital. So the company don't want to compromise in the liquidity, so they invested more into the working capital. So definitely the high current assets are there. The risk of liquidity will be very low, but the return will be very lower because the company is invested more money into the working capital. But when it comes to the aggressive working capital approach, in aggressive working capital approach, the company don't want to invest wisely or more into the working capital. It want to invest only aggressively into working capital based on the exact working capital requirement. So in the aggressive working capital approach, the working capital investment will be lower. So definitely the current asset will be low and the risk of liquidity is higher than the conservative approach because comparatively the working capital is lower in the aggressive working capital. So when it comes to return, normally it will offer a higher rate of return because the total investment in working capital is lower. If you are looking into the rate of return related to investment, your return will be higher. So these are the two approaches to working capital management. The first thing is conservative approach, then the aggressive approach. In the conservative approach, high cash and inventory level, high current ratios are there, then lower insolvency risk. In the aggressive policy, company will maintain only minimal inventory and receivable level and greater reliance on short-term liabilities and higher profitability but increase the liquidity risk. So these are the two approaches the companies the working cap to manage the working capital policies. So based on the company's policies and its requirement, the company will choose how much it should be aggressive and how much my working capital policy should be conservative. This can be decided by the company to company or case to case based on the scenario requirements. Then the negative working capital. Negative working capital means sometimes the working capital can be negative asset. Suppose if our current liability is higher than the current asset, in that case our working capital will become negative. Suppose let's look into an example. If a company said only for cash, there is no credit sales in some cases, suppose assume a retail company, it is paying only for cash, but its pay supplies in 60 days. Right? In this case, these companies have a negative working capital. It can successfully operate with a negative working capital asset because it doesn't have any investment in the current asset because it's getting all its goods by credit and paying by and selling by cash. So these situations normally what we calling as negative working capital. In the negative working capital case, our total current asset is lesser than total current liabilities. Again, negative working capital is not automatically bad. It is based on the context. In some cases, if our business model is suitable for the negative working capital, that means we can get the credit from the suppliers and we have the ability to sell all goods by cash. In this business case, we can run the business with a negative working capital as well. So with a negative working capital, don't assume that it is not bad. It is based on the context to context. Now we will look into how the transaction will get effect in the working capital. This is a common area in the exam that will confuse the students. There are some examples for transaction which is not affecting the net working capital. The net working capital here, you have to understand one thing. The net working capital is total current asset minus total current liabilities. Suppose there is one current asset exchanged for another current asset. Suppose a receivable collected. This is one current asset exchanged for another current asset. That means receivable from the receivable, we are changing the current asset to cash. That means our current cash is increased. So in this case, there is no net effect in the net working capital. There is no effect in the net working capital because it is impacted only within the current asset. That means one current asset from the receivable, the amount is moved from the receivable to cash. So this transaction, that is from one current asset changed to another current asset or exchange of one current asset to another current asset is not the effect in the net working capital. Then the current asset and current liabilities increase equally. If both current asset and current liabilities increase equally, it is not getting effect in the net working capital. For example, buying inventory on credit. If we are buying inventory on credit, our stock will increase, that is our current asset, and our payable also getting increased with the same amount. So in this transaction, buying inventory or credit, there is no net impact in the net working capitals. Then the current asset and current liabilities decreased equally. Suppose if we pay for account payable, that means our current liability, that is account payable reduced, and at the same time cash also reduced. So in this transaction, that means paying account payable, there is no net impact in the current net working capital because it is reduced both the current asset and current liability with the same amount. So these are some examples of transaction which is not born into effect or which is not have any impact in the net working capital. So now let's look into some other examples which is increasing the net working capital. There are some transactions which is going to increase the net working capital. Suppose increasing current asset without increasing current liabilities. If the only current asset is getting increased, that transaction will affect the net working capital. That means it will increase the net working capital. Then the decrease in current liability without decreasing current asset. If there is any transaction with decrease the current liabilities and without decreasing the current asset, so it is not have any impact in the net working capital. Then the sale of inventory at a profit. If a company sold its inventory for a profit, which will increase the net working capital because the sales value will be higher than the inventory. Both will, the inventory get reduced, and the receivable also will increase. But if you sell at a profit, our receivable will increase greater than this inventory impact. So this is a transaction which will increase the net working capital. So here is one more trick for example. So in this case, in all these cases, only the net working capital is only, in this case it is not affected, or here the increase in the net working capital, which is not directly linked with the ratio analysis. Again, the case also ratio can be changed. Even if there is no change in the net working capital, the ratio can be changed. So the net working capital and the ratio analysis has to be done separately in the examination to avoid this type of confusion. Then let's move into cash management. So if you are looking into working capital or into current asset, the one important component is cash. Cash again is the most liquid asset and crucial for survival. There are some reason to holding the cash. First thing, it is transaction motive. To manage the day-to-day operations, the company will maintain the cash. Then the precautionary motive. To maintain or to meet some unexpected requirements, the company can maintain the cash. And the speculative motives. For any short-term investment to invest any short-term investment opportunities, the company can maintain the cash. So these are the some motives to maintain the cash. Again, holding too much cash in the business can reduce the return because there are a lot of money staked up in the business. In this case, so it will reduce the overall business return. Again, holding too tight will increase the insolvencies. So the cash balance has to be maintained by considering these two considerations. That means we have to optimize the return and the insolvency risk. So the business has to find an optimal point where these two has to be maintained in an optimum level. Then the managing receivables. If you are looking into account inventory, or if you are looking into current assets, the receivable is one of the core component in the current assets. So the proper management of receivable is very crucial for the working capital management. So the main objectives or core objectives of working account receivable management is to collect the cash as quickly as possible without losing the customers. Here we have to manage the two things. First thing, we have to collect the receivables as quickly as possible. The second consideration is also very important. Without losing that customer or without losing that future expected business from the customers. So we have to manage these two things very wisely. So definitely the company has to offer the standard credit terms that is available in the market. Definitely they have to offer to maintain that customer and also to focus on to collect as early as possible also without compromising that customer expectation. So the managing account receivable is very crucial to maintain or to manage the working capital of the company. Then the managing payables. So normally as an objective to payables, always pay as slowly as possible without damaging credit reputation. If you slow more, it will damage the company's credit reputation. It will affect the future transaction and supplier relationship as well. So the key objectives of managing payable is to slow the payment without affecting the credit application or credit reputation from the industry. However, if a discount is offered, the company must compare effective discount rate versus borrowing cost. In some case, what will happen, the suppliers will offer a discount. That means if you pay your money within 7 days, you will get this percentage of discount. So in this case, what the management has to do, they have to compare that discount rate with the borrowing cost and to make a decision on whether to use or not use that discount. So let's move into inventory management. Then inventory is a crucial area in the working capital management. The proper management of inventory is very important to have a business success and also growth and to manage liquidity customer and the customer expectation. So the inventory affect lot of things. First is liquidity, storage costs, risk of obsolescence, production continuity, supply continuity. All these things will getting affected by the inventory. Again, holding more inventory will reduce stock of risk but increase the carrying cost. If you hold more inventory, definitely it will reduce our stock out cost. The stock out situation may get low, but it increases our overage carrying costs, like the working capital cost, the storage cost, maintenance cost, all these things costs will affected. But if we hold less inventory, it improve our overall return. That means if your investment in working capital inventory is very low, so overall return getting better, but it increase the operational risk. Maybe sometimes we may face to meet the customer requirement. So these types of operation risk also getting affected if you made a very low level of inventory. So to manage this inventory, you have to find that optimal level of inventory by considering all these factors. That means we don't want to affect a situation of stock out. We don't want to too much inflated carrying stock. We have to make it an optimum level or standard level of return, and we don't want to expose too much into operational risk. So all these things has to be factored while we are deciding an optimum inventory level. Then let's talk about some methods to short up financing. The first thing is the bank loan. Bank loan here that we are approaching a financial institution to get the financing for the short-term requirement of the working capital. So there are some forms of bank loan, simple interest loan, discounted loan, line of credit, and revolving credit agreement. So these are the some types of bank loan or bank facility available to manage the working capital. So based on the company's requirement, business requirement, the management has to choose the most appropriate method or form to finance their working capital. Then the factoring of receivable. Factoring of receivable means we are selling our receivables to a third party and collect that money immediately from the third party. So normally that third party is called factor. That means company sell its receivable to a factor for immediate cash. Suppose a company wants some immediate cash. So what it can do, instead of waiting to collect its receivable, it can sell its receivable to a third party. So definitely there are some discount will happen there in that sales. So definitely we have to pay some commission to the factor, or there are some interest charges, holdbacks. All these things will happen with the receivable factory. So the factoring of receivable is a method to manage the working capital requirement or to manage the fund the current asset. So now let's talk about the two forms of financing. First is secured and unsecured financing. It's pretty simple. Everyone know this. If it is a secured finance, there will be definitely a collateral there. Then the risk to lender is very lower compared to unsecured. Then the cost also lower because the lender may offer a lower interest rate for the secured loans or secured financing. If it is unsecured, there is no collateral. Again, risk to lender is very higher, and the cost also, to meet this risk, they will increase the borrowing cost as well. So there are some secured loans example. First one, inventory backed loan and receivable financing. These are the secured bank loans or secured financing methods. There are some example for unsecured also, short-term loans and commercial paper. Normally, unsecured financing is more expensive than compared to secure financing due to its higher lending risk. So due to this higher lending risk, lenders normally will take a higher risk and they are expecting a higher return from that investment. Then the cash forecasting. The cash forecasting is a method is to budget or to forecast the expected cash inflow and cash outflow of a business to see and to manage to forecast the cash requirement and to see the cash inflow of the business. So the key purpose of cash forecasting is to anticipate the shortage and to plan the borrowing, to plan the excess investments. So first thing, it's a key objective is to anticipate the cash forecast by putting all these expected cash inflow and cash outflow in a single form, that they can anticipate the expected cash shortage and they can plan the borrowing very advanced. So this will definitely will affect the companies to have better terms with the borrower. And is there any expected excess cash is expecting in any of the times, so they can plan the investment aspect. So this forecasting will help the plan the borrowing and plan the investment of excess fund. So by doing this proper planning, this will help the companies to borrow with the lowest cost and invest with the higher risk, higher return investments. So these are the key discussion today. So just key relationship to remember. So if we increase the current asset, it will increase the net working capital. There is an increase in current liability mean there is a decrease in the net working capital. Conservative policy mean conservative working capital policy mean lower risk and low return. That means they are maintaining enough or more than enough working capital in the business. Aggressive working capital policy means that it is higher risk and higher return. That means they don't want to maintain aggressive, very high working capital in the business or very high current asset in the business. So definitely the risk is higher and the return also higher. So let's move into the summary what we discussed today. So first thing what we discussed is the working capital management. Working capital management is the management of short-term asset and liability to ensure liquidity and operational efficiency. So it is a process of management of short-term asset and short-term liabilities to ensure the liquidity and the operational efficiency. So the key points are, first one, formula for net working capital, that is current asset minus current liabilities. Then what did we discuss about the operating cycle? Operating cycle measure the production to collection period, or in days. It is measuring how many days it is taking from the purchase to collection. Then the cash cycle measure the payment to collection period. That means how many days it will take to pay a supplier and to collect that money from the customer. So the effective working capital management include the proper management of cash, receivable, inventory, and payable. Again, in the case of working capital management, short-term financing played a very crucial role to have effective management of net working capital. Again, strong working capital management protect the solvency while supporting the profitability. A strong working capital is simply mean it is very aggressive, not a very aggressive working capital, and not a very tightened working capital. So it consider both edge. That is mean the profitability also considered and the solvency risk or the liquidity risk both also considered. So a strong working capital management, it will protect the both the solvency while supporting the risk return as well. So this is about today's discussion. What we discussed today is about the working capital management. So if you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.